Okay, I think we're live. Okay, so hopefully this is working. It's always such a hassle with this streaming nonsense. Okay, so I've got a few things I wanted to highlight. I'm hoping, wait a second. Yes, I'm hoping that you'll be able to see this cash flow statement here. So I've kind of tried my best to figure this out on the run. So I wanted to highlight a few things. So hopefully this is going to be a really interesting podcast. I always kind of try and think about what I would like to talk about, what would help me if I was on the other side of this equation. So I've tried to, hi Taylor, thank you so much for subscribing, by the way. I wanted to say that there was no way for me to write in the comment section. I wanted to write, thank you so much for subscribing to the other channel that I've got, Investment for Beginners. Thanks for doing that. And I also wanted to thank, by the way, a few people that kind of wrote in with some questions. And I wanted to thank particularly Miro for all your interactions with me on Seeking Alpha, for saying, you know, how to present, how to prepare for this. And there was a half Portuguese, half Brazilian or something like that person in California that also said, oh, Michael, I really want to kind of get up and watch this live at 6 a.m. So thanks for that as well. So anyway, okay, so I've got a lot of things to go through today. I'm going to try and get started right away if you don't mind, because I've got a lot of interesting things to discuss. Okay, first off the bat. Last week I tried to talk about cash flow here, so I'm gonna hopefully you'll be able to understand that, because some people wrote to me and said, Michael, I really enjoyed that discussion about cash flows, but I didn't really quite understand it enough. Can you please go through it again? So this is what I wanted to highlight, okay? So last week I talked about Farfetch. Farfetch's revenues for Q3. So this is just for entertainment purposes. I don't have any position in Farfetch. I did in the past. I was a shareholder, but this is not investment advice. This is just me kind of using this for entertainment purposes. Farfetch's Q3 results, revenues were up 33% year over year. And I said to some, and I'd written, this was stock that I'd previously owned back in May, and I'd written at the time in May of this year, I'd written to people in my marketplace saying, okay, I've lost confidence in this business. I know the stock is down. I don't know, it's like 20 or 30% of the time. I said, okay, you know, I know the stock is down, but irrespective of it being down, I'm not happy with the business's performances. I'm calling it a day. And I wrote at the time that I wasn't happy about the shareholder dilution taking place. So this is one of the things I wanted to highlight here. So hopefully you can see that, I'm hoping. So revenues were up 33% year over year. And at the same time, the outstanding shares were up 37% year over year. And I gave the example, if you think about as a business, if you're growing your revenues by 30%, but you're getting diluted by close to 40, I mean, what's the point of it? Is, you know, if you keep doing that over time, you're just going to end up with a smaller and smaller proportion of your business. So you're going to end up with, let's say, a business that has a lot of revenue, but ultimately your ownership of that business is immaterial. The other thing that I wanted to highlight particularly about the cash flows. So here are the cash flows from operations for the 9 months ending in September, okay? And you can see hopefully in the red arrow, let me just double check, you can see that. No, it doesn't, there's a bit of a delay at your end. Okay, fine. Yeah, so you can see on the red arrow, increase in receivables. So you can see that the business is recognizing those revenues, but those revenues are not translating into strong cash flows. So yeah, you're kind of getting revenues recognized, but if it doesn't transpire into positive working capital, there's not that much value to those revenues. As I said, you know, this is a business that I did own, so there's a lot to like about the business, but when you invest, it's really important that you have very little doubts. And back in May, I had some doubts about the business, and you know, sometimes it's kind of difficult because you're down, let's say 15 or 20 or whatever, it doesn't matter if you're down, and you have to say, okay, irrespective of whether you're down or up, if you lose confidence in the business, you need to get out of that. And I'm not doing some kind of hindsight analysis, you know, I said this at the time. And what I wanted to just highlight is that it doesn't really matter whether you're up or down. The share price does not know if you're up or down. What you paid is irrespective of what the business is worth. Some people say, oh, I'll just wait until I'm back to break even. Nobody cares what price Michael paid for the stock. It makes no difference. The stock doesn't say, oh, I'm going to wait until Michael's back at break even. the stock will be worth whatever the business is worth, and that's ultimately what is at play here. And so you can see that they had poor working capital performances. And as I scroll down here, I'm not sure if you can see, let me just see, I know there's a bit of a delay on your side. I'm just going to wait until it shows up. So the business had a capital infusion of $500 million, and you can see here, even if you don't understand what that means, you can just look through the cash flow statement and you see here cash flow from financing activities. Now I've kind of taken out some parts of the cash flow statement just to highlight this, but if you look on page 14 of Farfetch's press statement, you can see this for yourself, and you can see here that the business, got that infusion of 500 million, and that's really what's supporting the underlying business. And you can see similarly that in last year's trailing 9 months, they also had borrowings of 640 million. So they're really just, trying to grow their revenues, but it's kind of playing a very tricky game, and that works well until it doesn't, because it's a difficult game. You need to kind of, I'm all about investing for growth, I get that, but you want to be in a position where you're not getting diluted and the business is moving prudently and growing its revenues. Here you see that the revenue growth rates, that this is a business I understand quite well, is decelerating. You can see the shareholders getting diluted out and the cash flows are not that attractive. Okay, so that's about it that I wanted to talk about that. Still blurry. This is really annoying, man. Flipping heck. I don't know what to do. Okay, I'll have to move on for now. I'll just have to think about that at some other point. Okay, one of the topics that I want to highlight for today, I have written a little list here. So someone said to me, Mike, what's the difference between, like, a lot of people say great company or not great company? What does that actually mean? So what defines a great company is a business that can have high returns on invested capital. Really, that's it at its core. So you want to have businesses, Buffett typically looks for 15% return on investing capital as his hurdle to kind of invest in businesses. But typically what you want is that or higher. Obviously, some businesses like Moody's, some businesses have very, very high returns on invested capital, or they just they don't really know what to do with the business apart from buying back shares. So there are no other opportunities for them to kind of really grow their revenues, but they're very high returns on invested capital. So ultimately, this is what you want. You want a business that doesn't need to take more capital to grow. It can reinvest the profits that it makes to grow its revenue. So this is really what you want. Now, it's quite important because the bulk of the business's quality may not be immediately discernible today. In hindsight, you can look back and say, XYZ or Amazon or whatever was an amazing business. But that's, at the time, it's quite difficult. So I picked out Amazon because everybody knows Amazon, but a lot of these businesses go into folklore, and it's only later on that we kind of get this idea, that was clearly a good investment. Even in the case of Netflix, you look at that, does Netflix, that a good business? I don't really know. So it's quite difficult at the time you're kind of investing in. It's quite difficult to know because not everything you can appreciate in real time. It's only, you have to take a bit of assumptions as to the future of the business. But ultimately, you want to align yourself with businesses that are high quality, that has already talked about high returns on invested capital, and if possible, businesses that are founder-led. Now, let me just caveat that by giving 2 examples. Farfetch is a business that is founder-led. So, and I just described how that didn't work out for me. On the other side of the equation, you got Apple, which obviously Tim Cook is leading that, and by any stretch of the imagination, more returns have been made and more profits have been made under Tim Cook than Steve Jobs ever made. So, I can argue this in the 2 cases. Not everything that you do in investing is a hard and fast rule. And for every hard and fast rule that there is, there's something else that you can see from the other side that it shouldn't work. Like Tesla could be a great example. It shouldn't work, but it has worked. Or GameStop or whatever. It doesn't really matter. There's a lot of these kind of things that I wanted. It's quite difficult, and that's why investing is quite fascinating, because for every one rule, there's a different rule that kind of breaks it, and that's why it's quite interesting. Now, someone asked me a question about stock-based compensation, and I kind of try to write some notes here to try and explain this in the way that I see it. You may see it in a different perspective, and that's fine, but I just wanted to highlight how I see things. So in the past, if you were, let's say, a car manufacturer and you wanted to grow your business, you'd take on some debt onto your balance sheet, and you would take that cash and buy a plant. Okay, so your earnings, a portion of your earnings will be redeployed as capex to grow the plant, and then you end up with the debt on the balance sheet. Okay, so the free cash flow figure is small, but the earnings are large. Okay, and nowadays a lot of businesses are asset light, so they have a lot of stock-based compensation, and it's the case that if you look at the GAAP earnings are small, but the free cash flow is large because the stock-based compensation is a non-cash expense. So what is happening in that case is that the business is handing over shares to the management team, and that is ending up as on the balance sheet and the equity, because the equity becomes a larger equity base. So in the past, it was the fact that you'd end up with a lot of liabilities because the debt would be large, equity would be small. In this case, it's kind of reversed, so it's like an expense that you're investing in the future, investing in this management team, and the equity base gets diluted out. Now, two things. Firstly, when you look at a business that has a lot of stock-based compensation, I like this business a lot, I don't actually own shares in it, is Snap. So Snap has quite a lot of stock-based compensation, but you already see that reflected in its market cap. So when you see what the market cap is and you think, is Snap underpriced or overpriced or whatever, you're looking at the market cap. You're not necessarily looking at, let's say, the number of shares, it's at $50 or $60, that doesn't make any difference. You're looking at what's the total sum of the business that you're owning. The advantage of having the stock-based compensation is first from the funding perspective, that you don't need to kind of give anyone cash for them to work for you as much. You can take my points and it's obviously exaggerated slightly. You do need to pay them some cash, but you are handing over a large portion of the business to your management team in the hope that positively incentivizes them to move the business forward. Of course, for everything there's kind of positive and negative aspects to that, but at its core, I think that stock-based compensation gets a lot of bad press, particularly by quote-unquote value investors, but really it's not as big a problem, because you're paying your management team and they're going to be driving themselves to kind of move the share price higher. So that's one of the things that I wanted to highlight. Okay, the other thing I wanted to highlight, so I'd written all these notes about today's podcast yesterday, and it's kind of interesting. I always say that in the stock market, a week is a long time, and I wrote these notes about what I was going to write for today, and then kind of today I came, two things happened. So the first one was that a company that I own, Pinduoduo, reported a result, so I had to kind of spend a lot of brain power on that. And then obviously the new variant came around, and if I felt before that a week was a long time in investing, nowadays it appears to be the case that a day is a long time in investing. News comes out and everyone around the world panics and everything just sells off so quickly, and it's kind of interesting. And I think myself, man, like if we look back, for example, to let's say 2016, 2017, there was kind of the stock market was quite smooth, kind of just trickling up, and in 2021, man, it's really just all over the place. It's so difficult, and this kind of is testing. Obviously, it's very, very difficult for investors, because you're having this kind of so much fear and uncertainty, and a business doesn't really oscillate that much. The business can kind of move in a certain direction over time, but businesses take time to kind of either grow or to shrink. It's not something that happens overnight, but the share price has just been really volatile, and it's been so crazy. And I think that I always say to people, so someone said to me, should I keep some cash on the side in case there is a crash? And when I read that, I said, okay, there might be a crash at some point, but you're not going to have it in you, the emotional predisposition to invest at the most scary moment. And it's much easier for you to be buying a business, and let's say every 6 weeks or so, or whenever you get your salary, you just allocate it equally into your portfolio, rather than you trying to keep cash on the side, and when there is a market crash, you kind of put it in the market crash. Because you're not gonna, there's no one that rings a bell to say, hey, this is the bottom tick, everything is safe after this moment. That's not going to happen. And if you invest too early and you see that the sell-off continues, you kind of get really nervous and anxious that you missed time the bottom. And the next thing that you do, if you're kind of trying to time the bottom, is that you're not aligning yourself with the wealth of that business. The wealth of that business comes by you holding on to that business over a period of time. Your return is proportional to how long you've owned that business. It's not in the buying or the selling that kind of makes your return, because over time your emotions will even themselves out, and it's just down to the element of luck. The next thing that I wanted to talk about, that I just kind of led to, is the role of luck in investing. So let's say, for the sake of discussion, that you are 60% right in investing. That means 40% of the time you're not going to be a successful investor. But over time, that 60% is really, really rewarding. There's a quote from Peter Lynch that says, if you can be right 3 out of 5 times, you're going to do really well in investing. And so that 60%, it doesn't come out neatly throughout the year. You may have a period where you have a lot of winners and you just feel great about yourself, and then you're going to have a period where it groups together all the losses. So you're going to be taking a loss after a loss after a loss after a loss. And I've read Ed Forbes' book on The Man That Beat All Markets, and he talks about having enough bankroll to stay at the poker table for a long time. And he talks about the Kelly formula and stuff like that. And even if you don't know anything about this, the point is that you have to stay in the investment game. And you have to, I quote a game because, just to kind of sound kind of quirky, it's not quirky, but you have to stay in investing. And it's very difficult for you to kind of go all in at the most difficult time. And I made some comment about this in the last week's episode. I said that of the people that knew back in 2019 that there would be a stock market crash in 2020, a really, really small amount. And of those that predicted that there would be a stock market crash in 2020, how many actually figured out that the S&P would end up 16% higher from the start of the 1st of January to the end of December? So investing is really unpredictable. And someone gave me this quote, which I'm going to just steal from myself, that I cannot really control the market. What I can control is the businesses that I give my capital to. And that's a really powerful mindset. So if you think of it, when it comes to investing, you're just trying your best to align yourself with businesses that have staying power, with businesses that I described at the start about being high quality. If possible, you want to be aligning yourselves with founders as well. Not always, and there are exclusions for all of these, but it's a game of odds, and you want to have as much as possible the odds in your favor. Don't go after investments that have a 50-50 chance of working out. And those 50-50 chances of working out are often not actually 50-50, they're actually a lot less. So a lot of times, I see this right now, there's a new IPO with some new technology, and it's AI driven and 3D technology and machine learning, and is well disposed for the digital movement of this age, and it's all just like blah blah blah. And it's just, you got to think yourself, when I'm paying, let's say, 80 billion market cap, and this business is pretty much with no revenues, like, what am I actually paying for? So the odds in that instance would not really be favorable. It will be less than 50-50. And I understand the narrative. The narrative is so attractive and everyone else is talking about it on CNBC, and I don't want to pick out the specific company that I'm thinking about it, because you probably know similar cases like this, but it's just really the case that the way to invest often is to invest before other people invest in that space, but it's not by being the soonest in the business life. You just want to invest before other people come around to seeing the business the way you do it. So I find myself very much leaning towards businesses that have fallen out of favor, and I find that it's quite difficult, because when you're investing in businesses that are out of favor, it's not that next quarter everything is going to be okay. You're kind of investing. Oh, sorry, my phone is just going crazy there. So yeah, it's not that next quarter the business will just immediately improve. It's often very much the case that it takes a long time, because business is a bit like people, and sometimes they kind of take a long period of time to kind of dust themselves off. So when it comes to selling the stock, that's the last point that I wanted to kind of highlight here, is don't look to sell the stock before you've held it for a considerable period of time. I always say I want to hold the stock for at least a year. And what that does, it forces two things. In the first instance, I know that before I buy the stock of XYZ, I am going to be holding on to that business for at least a year. So I'm forcing myself to build the conviction to hold on to that business for a period of time. So I'm having to say, before I buy those initial shares, I'm saying to myself, there's no exit here. I'm going to have to stay with this business even when sentiment goes against this business. And as I said, I'm a contrarian investor by nature, so I understand that I'm going against the crowd and I'm buying things that people don't want to buy right now. So it's not that I'm buying things that people don't want to buy right now and then next quarter everything is going to be okay. So that's the first thing. I'm buying into businesses and I'm going to hold them for at least a year. The next thing I want to say, don't sell out of a business just because the share price is going down. Okay? Write to yourself why you buy in the business in the first instance, and unless you can point to something to say, exactly, this is the thing that I thought was going to work out and it clearly isn't working out, then don't sell the business. So I've got another rule that I kind of helps me a lot. If the number of customers or users is going in the opposite direction, I'm not talking about having one bad quarter, I'm talking about if you can see that the customer growth, the customer adoption curve is going in the wrong direction. So it was going up and up and up and you invested and then it kind of is coming down, down, down. That is not a very successful business. Don't try and kind of bottom tick and expect a re-rating. A lot of value investors kind of think that just because they buy something cheap, it's going to dramatically re-rate higher. That's not how it works. I am very much of the inclination to buy something cheaply, but it's important to have some kind of preliminary understanding of where the business is going. So a business that I always talk about it being FUBU. So I mean, you can see that the share price has continued going down, and there's every reason, I've heard every negative argument about this business, but you can see that fundamentally the number of subscribers using that platform continues to grow. So I know that I'm not going to unpick the investment thesis of FUBU, but this is a business that the share price is going down, but the customer adoption is going up. So it's difficult. And I always wish that, whenever you make an investment, it just would go up neatly 15% a year. That would just be terrific. But when you make an investment, you're kind of saying to yourself, okay, I'm not going to leave this business for at least a year. And if possible, if I see by any stretch that the business is moving in the right direction and the share price is up, let's say 50 or 60%, because when is that re-rating and the stock goes higher, it's because the business is doing something better than expected. Okay, and so don't sell out of a business that you've made the right investment. If you happen to have made a great investment and you've happened to see that the share price is up, let's say 50 or 60 or 70%, don't sell the business. So I'll give you an example. Someone asked me a few weeks ago, oh Michael, do you wish that you'd sold Upstart? You're up more than 100% in 90 days. No, I don't wish that I'd sold the business, because I don't think that if the business is doing something well, why would I sell? If I've been lucky enough to buy a business cheaply, yes, I know it's gone up and down, and I wish that the world was perfect, but it's not. But just stay in the course. As long as the story is strong, as long as the fundamentals are moving in the right direction, don't sell out of the business. So in the future, if I could talk about holding versus taking profits, that's a really good topic. So I'm going to just address that here today, but I'm going to write that down to talk about it in more depth next Friday. So only sell out of a business that you can see categorically it is failing on your thesis. Don't sell out of a stock just because the share price is up. Don't sell out of a stock just because you have made 20% on it, okay? Just sit down on your hands and don't do anything, because if you're lucky enough to have found one of those businesses that actually does something impressive and has a strong customer base, has a loyal customer base, just try your best not to do anything. And I know the urge to kind of sell something because you want to crystallize your profits, but don't do that. And sometimes, I'll give you a different example. So a stock that I own called Digital Turbine, they're clearly moving in the right direction, and the share price has just been all over the place, and I can see that in hindsight, there was a lot of points where I was holding meaningful profit, and now I'm not. But I can see that it's like a pent-up coil. I can see that there's a build-up of kinetic energy. The business is clearly growing and clearly doing everything right in their power, but they're not being recognized by the investment community. And I remember there are times like this that is really, really frustrating. And just before I wrap up, I just wanted to highlight one more thing. So back in 2015, I invested in Google. It was called Alphabet, it was called Google at the time. And I was investing, I was still kind of a newbie to this. And for 1 year, that share price for me went nowhere. And it was like, everyone was telling me that it was dead money. And I was like, oh, it's dead money. Yeah, I should kind of go into something more sexy. And obviously, I got a lot of hindsight bias there. I know that. But just because something kind of has the illusion of the share price not going anywhere, sometimes 12 months is a really painful time in investing. But just if you have profits and the business is clearly moving higher, and it has to be moving higher because it's delivering against people's expectations. People are being positively excited towards the business. Do not sell your winners. Just try and sell your losers. And I could actually talk about next time how to deal with selling losers in next week's episode. I'll write that as well down. Okay. People, thank you so much for your time. I really appreciate everyone for coming. It was like, I think that was one of the best turnouts for me. Thank you so much, Taylor. I really appreciate all your support. And yeah, thank you everyone. I really appreciate you kind of giving me your time. Thank you so much, and I hope to see you next Friday, 9 a.m. Eastern Time. Thank you so much. Bye-bye.